The hard thing about the crypto ecosystem is there is so much happening all at the same time. I mean, they've just raised $60 billion in venture capital and everybody's building out projects, whether it's lending markets, financial markets on DeFi, whether it's putting traditional financial markets onto blockchain rails, putting real estate onto blockchain, whether it's building, doing really interesting things with NFTs, such as ticketing. So we're seeing Ticketmaster has issued 10 million NFTs, the largest NFT issuer in the world. That's going on. We've seen Solana building a phone which integrates all Web3 in your wallets. You've seen, I mean, there's literally almost too much to keep on top of. So, how do you pass through all of that excessive information? You start looking, okay, what are the main chains that the activity takes place on? And the main place is Ethereum, and then places like Solana, Avalanche, Polkadot, and a few others. So that's how you kind of filter down. You see all of this stuff going on. You're like, oh, this is overwhelming. But then the great thing is what platforms they're being built on, and then we can invest in the underlying platforms and protocols.
Hello, welcome to our channel. In today's video, Vision CEO Raoul Pal updates about where we are in the Bitcoin market cycle right now, the best ways to survive in a recession, and the key factor that drives the asset prices like crypto and stocks. Make sure to stick around to the end of this video, where Raoul Pal reveals the secret reason why he bets high on cryptocurrencies, especially in times of a financial crisis. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
Well, nothing is foolproof in this world, right? All we're trying to do is get probabilities in our favor to try and roughly assess. But here's what's simple, is if you look at a chart of the ISM over the last 50 years, it goes up and down in cycles. The economic cycle, we all hear that term. What it means is kind of, that if it's rolling over, it's likely to go all the way to recession. It doesn't always happen, but your probabilities are high. And once you're in recession, it tends to start picking up again, and that gives you the green light to maybe buy some of these things. So in a very simple terms, you're looking, the 50 line in the ISM is roughly where it goes to contraction or expansion. If it's coming down and going through 50, you start to worry about recession. So currently, while we're doing this, I think the ISM is somewhere around 52 and on its way down. So we're starting to think, oh, there's probably a recession coming. And when it comes up through 50, you're kind of being given the green light.
Bitcoin kicks off a new week by keeping everyone guessing, despite the fact that its trading range remains extremely tight. The familiar status quo for Bitcoin, which is just above 19,000, despite the lack of volatility over the weekend, was maintained. The crypto has not yet made a decision on a trajectory or even signaled that a breakout or breakdown is imminent, despite the fact that there has been calls for a rally and a run to lower macro lows in the near future.
So it's actually a little bit of a tricky point in time today, but we're getting very close to the time where the markets will start saying, okay, I can see what's going to happen here. The economy is going to go into recession. The Federal Reserve will stop raising interest rates, as will the other central banks. And chances are things start reversing again.
Bitcoin's price action has returned to where it was at the same time last week, putting the cryptocurrency back where it started after a brief period of excitement brought on by the economic data released in the U.S. the previous week.
Because you want to be ready when nobody else is, when everybody's being forced to throw all their trades out and stop themselves out from losing money. You want to be able to buy. So you kind of want to have cash ready. And then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take an advantage of the sell-off in crypto and the sell-off in stock markets and technology stocks? Because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. You don't want to take as much risk because you don't have an income. So your grandparents don't have an income anymore. So it's just their pension. So they need to be careful very careful with their pension. Their nest egg has to be protected at all costs.
Even though the Federal Reserve is not expected to make many direct policy changes this week, there's still plenty of fuel for cryptocurrency volatility that is going to be provided by external forces. Earning reports from companies will be pouring in thick and fast in the U.S., with technology stocks having a particularly high potential to move markets in the event that results are significantly below expectations. Over 20% of the S&P 500 is made up of reporting companies. This year, the S&P 500, along with other U.S. indexes, is exhibiting unusually poor performance.
Yes. So if you think about it, what is macroeconomic investing? It's using the economy to understand the direction, the future direction of assets. Why does that happen? Well, simply, if the economy is booming, people have more money to spend, and it tends to be positive for assets. And if the economy is slowing down or negative, then you tend to find that asset prices don't do as well. Kind of makes sense. Some assets work the opposite way around generally. So usually when things are slow, bonds do very well, but equities do badly, for example. And the easy way to see this, well, it's not so easy because you can't do it without putting it in a spreadsheet. It's actually the year-on-year rate of change of almost every asset, whether it's copper, oil, the S&P 500.
The outlook for Bitcoin becomes more uncertain as time goes on, and those who are adept at deducing bearish outcomes from the most recent chart data are busy drawing parallels to the bear market bottom that occurred in 2018. The Crypto Fear and Greed Index has now had sentiment in its fear or extreme fear category for 2 consecutive months in a row, which is a sign that has captured the industry so far this year.
Everything is always different, but it's always similar. So the question about 2008 was different. 2008, we had a financial crisis. So we had another thing. It wasn't just the economy slowing down, but we had something much worse. And 2001 was much worse. We had the biggest stock market bubble in history that unwound. This time around, I'm struggling to see what that big thing is. Yes, we've had inflation, which is different to the prior cycles. But inflation is also driven by the business cycle, and it should come down over time. So I don't see the really terrifying outcome. Of course, some companies might go bust. People will lose their jobs. Maybe some weaker economies will suffer badly. But generally speaking, I'm not picking up, oh my God, we've got a debt crisis coming or something really bad. So I think it is different. And so a lot of people are expecting the next leg down. Is this going to cause the crash? I mean, the market's already down. I mean, the Nasdaq's down 27%. It was down 35% or so. It's pretty much crashed once already, but people are like, can it go down 50%? Because they look back at 2008 and 2001 and said, see, it can do that. When you go back to other recessions like 1990, it was a 20% correction. In fact, even when the Volcker years, the famous time when Paul Volcker was raising interest rates and slaying inflation, the market fell 27%. So it wasn't the big one, but 1974, it fell 50%. So we don't know whether it's a 50% sell-off, which is usually driven by something much worse, or something around 30%, which is roughly what's priced in right now. I'm erring to the 30%, so i.e. the risk reward is looking more attractive than if we were in 2008, where we had something much worse going on.
The Fear and Greed Normalized Score for market sentiment is computed using a basket of factors, and the results for 2022 has delivered results that are unlike those of most years. Earlier, the index experienced its longer ever stint in extreme fear, a feat that is currently 1 month away from being repeated. Currently, the index is 1 month away from repeating this feat. At the moment, the index was measuring 2100, which is approximately 10 points higher than traditional bear market bottoms, but an entire 14 points higher than the low point reached so far this year.
If you're young, the single best risk reward is crypto, because it's the only market that goes up 10, 20, 50x, while the stock market may double, may go up 200% over the next 5 years, but crypto market does a lot more. So if your aim is to take risks to accumulate wealth, then crypto. I prefer crypto as a bet because I think it has a better risk reward than other markets. But you have to suffer these drawdowns, and a lot of crypto is down 60, 65%. But if you're less risk seeking, you might just want to buy equities. If you're slightly more risk seeking in equities, you might want to buy technology stocks, because technology is not going away. I mean, the rise of everything from AI to robotics to EV to space travel to everything is all happening at the same time. We've got this huge inflection point. So clearly that's going to be something that's probably going to generate a lot of profits over time. So I think it depends where you want to be on the risk curve. Some people like physical things, so they like to own stuff like oil companies, because there's not enough oil being produced currently for world demand. So maybe over the next 2 or 3 years that does well, but those stocks tend to be mean reverting. They kind of just go in cycles. They're not the buy and hold that technology can be or crypto can be. So I prefer technology and crypto overall.
So what do you think is the best strategy to survive in a recession? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.